Hey, everybody. Hope everyone is doing well and had a good day. So, the daily chart, move some of this around. You can see on the, let me check the sound really quick. Looks like the sound is working. On the daily chart, we're getting closer and closer to the all time high. And I suspect that we're probably going to get there. We're close enough that the reality is probably going to get there. The question is, do we have to pull back first? Tight bull channel, and therefore we almost reached, we actually touched the low of yesterday. We're probably going to fall below. It's a micro channel, and now we have an 8 bar micro channel. Where the odds are we're going to fall below a bar in the micro channel. The problem for the bulls is that the risk is getting relatively big for the bulls. So probably buyers below. Easier to visualize like this. Lots of bull bars on the way up. Probably buyers below in a second leg. Now, what do the bears need? The bears, they want a double top with the December 6th high. But realistically, the bears, they need to do more than this. This is not enough selling pressure, and it increases the risk that we go above 6,200. So at a minimum, I think the bears need to make the market go sideways. Weekly chart, tight bull channel, trend line break, retesting the highs. We can break above the highs. This is a strong enough rally that I suspect buyers below. It's Thursday, so we only have one day left. I think tomorrow is probably going to try and put a tail above the bar. So if tomorrow is a bear bar closing on its low, that will create disappointment on the weekly chart. And you can see on the 60-minute chart, we've been in a bull channel for several days. We're getting a big breakout. We're getting a breakout bar late in the channel, breaking above this high, but it's a fairly climactic bar. And that makes me think we're going to get a couple of legs sideways to down. Probably not going to fall. Do we fall to 6,100? We might before tomorrow's over. Tight bull channel, trend line break, higher high, major trend reversal, but a lot of bull bars on the way up, and that lowers the probability for the bulls buying. Feel free to ask questions. I'll take a look at them here in a few. Daily chart, or excuse me, in the 5-minute chart, the market gapped down on the open and formed a double bottom with one decent reversal bar closing on its high. You can buy above one, low probability buy, and higher probability to wait and see what the follow through looks like. But at the moment, I suspect we'll get at least a small second leg up. 2 consecutive bull bars, good for the bulls, probably by the close, but fairly tight channel. We may pull back and test the one high before we get a second leg up. 3, and that's what we did on 3. 3, we have a tail below the bar, but it's a bull bar. 3 consecutive bull bars, still by the close, probably buyers below. But because of the tail on 3, that limits the amount of traders that'll be eager to buy the close of 3. And therefore, I suspect 4 might be disappointing. 4, inside bar, disappointment bar, probably buyers below in a second leg up. 5, we triggered the buy above 4, bad high 1, and therefore we may end up going sideways here. I wouldn't be surprised if we have to test down and test the low of 1, or even break below 1 and reverse up. 6, we broke below the micro channel with 5. So a trend line break and a retest of the highs. It's a high 1 buy signal bar, but probably high ones in a tight in a tight trading range increase the risk of sellers above. And then 7, bear bar closing near its low, but a tail below the bar. Big bar, big risk, bottom third of a tight trading range, probably buyers below 7. 8, a doji, disappointment bar, probably going to bounce and go above the 5 high. The bulls, they want a double bottom with 1 and 8, break above the neckline 5, and rally for a measured move. So this is what the bulls want. They want to break up here. 9, inside bar, good for the bulls, probably going to get a second leg up, but an inside bar in the middle of a tight trading range, really not ideal. And then 10, we have a bear bar. For the bears, it's a relatively small bar, and therefore probably buyers below in a second leg up. And then 11, we have a weak stop entry buy for the bulls. We may get a second leg down after 10 and 7. So 7, bear bar. This might be a pullback that leads to a second leg down. And the bears, they see 10 as being stronger than 11. So probably sellers above 11. 12, second leg down, but a possible triangle, 1, 8, 12. Good bar for the bears. However, it's implied 2 legs down. Second leg down from the 8 low, pull back to 10, second leg 12. So leg 1, pull back leg 2, and then leg 1 with 11, pull back during 11, leg 2, 12. So the bears, they have a triangle in general, 50-50 probability. I think the odds are slightly higher that the breakout below yesterday's low is going to fail. And that's because of the 60-minute chart. So here, 60-minute chart. Tight bull channel, trend line break, but not enough bars. 20 gap bar buy. Probably going to test up to the high of yesterday or near it. 13, bad follow through for the bears. Always in bears, I'd get out above 12 or during 13 or above 13. Bulls, they can buy above 13, stop below 13, or probably better, 1. Betting on the break above the neckline, 5, and a rally for measure move up. 14, follow through, but a weak follow through bar. One moment. Sorry about that. 14, disappointing follow through. So we may end up going sideways here. And then 15, we have a breakout bar. For the bulls, it's a 3-bar micro channel. And the bears, they do not have a reasonable sell signal bar. And therefore, looks like we're going to get a second leg up. The bulls, they see the break above the neckline 5. They want the market to rally at a minimum where my mouse is up here. And the bears, the bears, they want a second leg trap, rally, pull back, second leg trap. But one of the important things to notice here is bar 1 is the low of the day. And that means if you bought above 1, stop below 1, you never got stopped out during 12. And therefore, that's a sign of strength by the bulls. 16, follow through, but a tail above the bar increases the risk that we go sideways soon. What about buying? What about selling the close of 16? No way. Too many consecutive bull bars, and therefore better to wait to sell. Another bull bar, but a tail increases the risk that we may pull back soon. We have a bull bar and then a doji, bull bar, and tails above bars, so we may start to stall. What about selling? I would not. It's a micro channel. It's a breakout on a higher time frame, and therefore the pullback might be 1 bar. And then 18, we have an inside bar. You can call it a breakout pullback buy or a high 1. Even though this rally looks weak, it's strong. It's a micro channel, and therefore it's deceiving. If you look at something like a 15-minute chart, it's a strong breakout and follow through. The problem for the bulls, it's in the middle of the overall range, and that makes me think we'll probably go sideways fairly soon. Climactic bar, 19, so a profit-taking bar, parabolic wedge with 16, 17, or 18, and then a third leg on 19, so I'm probably going to test the bottom third of 19 in the minimum. We went below 19. For the bears see a parabolic wedge and a decent bear bar on 20, but selling pretty low. The odds are there's probably buyers below the 19 low. Strong enough surprise, we may get a second leg down, but really not ideal. And you can see what happened on 20. 20 sold off, testing near the 5 high and reversed up. So bulls bought the close of 19, scaled in lower, made money. 21, it's a breakout pullback buy. You can call it a high one in the upper third of the range, but the reversal up on 21 is strong, and that increases the odds. There's probably buyers below, and we'll probably get a second leg up. Doji, 22. So you can see buyers near the close of 20, but again, not a good reason to sell. And then 23, second leg up for the bulls. Good for the bulls, probably going at least a little bit higher. And then 24, almost outside up. You can call it a breakout pullback buy. The bulls, it's good for the bulls. One of the problems that the bulls have here is we're starting to get overlap. So the market is in a channel. And therefore, that increases the odds that there's going to be disappointed traders. And instead of traders buying closes, traders will begin to buy pullbacks. 25, bear bar. We rallied, pulled back, rallied, pulled back, rallied again. And now we're trying to pull back. So I suspect because of the parabolic wedge, we may have to test lower near the 24 low. And 26, we broke below the parabolic wedge, but really not ideal. You can see it's a tight bull channel, and therefore not a lot of bears want to be selling low in the channel. Consecutive bear bars, 25, 26. And therefore there might be sellers back at the 25 low. 27, a bull bar. What about buying above it? You can. The channel's tight, but rally, pullback, first, second leg, pullback, possible third leg. And I suspect traders selling above 27 are probably going to make money. And you can see what happened. We broke above the trend line for the bears, for the bulls, excuse me. We broke above it, failed, and reversed back down. Did not mean to do that. 35, testing down. It's a wedge. 1, 2, 3. Decent bear bar 35, so probably sellers above. Even though there's a tail, traders may not sell to close. However, they'll definitely sell above, expecting a second leg down. Because this is the bottom of the channel or the start of the pullback, it's reasonable to assume that we may try and test all the way down here. 40, a bear bar, good for the bears. However, 2 legs down, sell off, pull back, second leg down. And therefore, 31, sell off, pull back, second leg down. 4-bar micro channel, so probably sellers above. But as far as selling closes, probably better to sell a pullback. And then you can see 32, a bull bar, but a tail above the bar, probably sellers above, scaling and higher. And then 33, consecutive bull bars, but a tail above 32, and then a bull bar closing on its high 33. That might be 2 legs up on a smaller time frame. And therefore, 33 might be more of a sell to close bar than a buy to close bar. 34, doji. So the bulls who bought the close at 33 disappointed, increases the risk that we test lower. At a minimum, I think it probably will test below the 31 low. Strong enough breakout, it'll probably get a second leg. 35, bear bar, breaking below the low 1, and you can see some traders disappointed. They sold the close of 40, scaled in higher, trying to get out break even. 36, doji, probably going to go mostly sideways here. And then 37, bear breakout below the 31 low. And a lot of disappointed bears bought back shorts and bulls bought with them. What about buying above 37, betting on a double bottom? I would not. It's a bad buy signal bar above, and therefore there might be sellers above this bar, and we have to test a little bit lower. Then we got an inside bar on 38, probably going to trigger the sell and fall below the 31 low. And you can see that's what happened with 39. For the bulls, they will see 39 as a double bottom with 31, with the second leg forming a wedge, 35, 37, 39. And therefore, it's a reasonable buy, stop below 39, betting on a rally above the 28 high. Follow through 40, good for the bulls, probably going to get a second leg up. And then another bull bar 41. Now we have a 3-bar micro channel, probably buyers below in a bounce. And you can see 42, looks like we're still going higher. Doji 43, so a warning that traders are beginning to take profits. However, the bears are not getting any selling pressure. And you can see we got an inside bar 44, and that led to a breakout bar 45. 45, good bar for the bulls, but high in the range, probably more of a profit-taking bar than a buy-to-close bar. And then 46, follow-through buying. Again, good for the bulls. We may get a small second leg up, but 46 is smaller than 45, so really not ideal. And then 47, another bull bar, still always in long, but now we have a breakout, pullback, and we're starting to form a channel on a smaller time frame. And that makes me think we're probably going to test back to the 45 close fairly soon. And then 48, we reverse down. Good for the bears. We may get a small second leg down, but a fairly tight bull channel. I think it's better, instead of selling, wait to see what the pullback looks like and then look to buy. Bull bar 49, testing the high close 47, but I suspect sellers above and a second leg down. And then 50 is second entry. You can call it a second entry sell, but fairly tight bull channel, not really ideal. Again, I'd rather wait and see what the downside breakout looks like if I'm going to sell. 51, good for the bears. We may go a little bit lower, but possible 2 legs down. With 48 and 51. Follow through 52, good for the bears, but I'd rather see the breakout. And then a doji 53. This looks like this might be a bear leg and will become a trading range and not the start of a strong sell-off. The bears, they want to rally, pull back, higher high major trend reversal. But this is probably more of a minor reversal than a major reversal. Doji 54 looks like we're going to be sideways, and then outside down, almost outside down 55. A lot of overlapping bars in a fairly tight channel, testing near 50%, probably going to pull back. And then, and by pullback, I mean probably going to bounce fairly soon. 56, bear breakout bar, but a tail below the bar. If anything, there's probably buyers below the bar. And then you can see 57, another bear bar closing on its low. The bears are owning the market in terms of time right here. And therefore, that reduces the chances that the first reversal up is going to be major. However, the one problem that the bears have here is big up, big down. And there's a lot of overlap here. And therefore, the bounce might be fairly deep. We have a rally trend line break. We may need to form a lower high in the upper third of the range. And then a doji 58 looks like you'll have bears beginning to take profits above the bar. And then you can see what happened. 58, bad low one, and then 59, we triggered the low one and reversed up. 59, good for the bulls. Probably going to go at least a little bit higher. Follow through 60, so probably buyers below in a second leg up. And then 61 for the bulls, it's 2 leg. For the bears, they'll see it as 2 legs up. 59, pause 60, second leg up. 61. But really not ideal to be buying here. I suspect we're probably going to get at least a test down. And then a doji 62, a barrel bar closing in the bottom third of the range, but an inside bar and a fairly tight rally. 59 low, 61 high, so probably buyers below and at least a brief second leg. And then a high 163, looks like we're entering breakout mode. 64, second entry short, but not ideal. And you can see 66, we got a second leg up, and then we pulled back. The bears, they're not getting decent sell signal bars, and that's a problem for the bears looking to sell with stop entries. They tried to break below 67, 66 on 67, and they couldn't do it, and then we turned up on 68. Tight trading range, breakout mode. The bears, they see this tight trading range as a bear flag, and they want trend resumption down. The bulls see the rally as the first leg. They want this pullback to be, they want this tight trading range to be the pullback that leads to a second leg up. And then 69, bull bar closing near its high. Looks like it may go a little bit higher. 70, a doji. The bears, they're not getting a sell signal bar, and you have to ask why. And then you can see 71, bull bar closing near its high. Good for the bulls, but a lot of overlap. Probably better to wait and see what the breakout looks like. And then a bear bar 72, follow through 73. The bears, they see a wedge. 1, 2, 3. And they're hopeful that this is a higher high major trend reversal. The market went about 1 tick above the 48 high and reversed down, but not a great sell signal bar below 72 and weak entry bar 73. So it looks like a maybe sideways here. And then 74, 75, bear bars, but the body's getting smaller and the overlap is increasing, and therefore we're probably going to bounce soon. 76, bull bar closing near its high, a little bit of a surprise. Good for the bulls. They're hopeful that this leads to an upside breakout. And obviously 77, we got the upside breakout. And then always in long, bulls, they're buying the breakout as it's going above the channel. They're sensing that the momentum is increasing. But one of the issues for the bulls buying is they know they're buying momentum. And because of that, if they're buying momentum on the way up, that increases the chances that there's probably sellers somewhere above. And instead, you can see we got a strong follow through bar for the bulls. Consecutive bull bars, 77, 78, good for the bulls, but fairly climactic. And therefore, looks like we'll probably pull back during the Globex session, but a little bit of surprise. The bears need to build selling pressure. For stop entries, I thought the buy above 1 was reasonable, or you can buy above 2. And then if you do, I think it's okay to be quick to exit when you see the dojis 4, 5, and 6. Otherwise, if you bought above 1, you put your stop below 1. And as far as getting would I sell below 7, I would not. So in that case, if I'm long, I'd rather rely on my stop at a minimum below 1, or maybe some distance below 4, 5 points below 1. And as far as selling below 10, not ideal, middle of a tight trading range. And if the bears that did sell below 10, when they see 13 start to reverse up after 12, they get out. Bulls, they buy above 13, stop below 1 or 12. And then where do those bulls get out? Some might get out below 20 due to the parabolic wedge. However, they'll be pretty quick to buy as 21 starts to reverse up, or buy above 21. And then the bulls that bought above 21, I think they can get out below 25. And as far as buying above 27, I would not. Buying 27 is buying the third leg up, and it's probably going to form a trading range fairly soon. And then as far as selling below 30, you can if you're quick, but not ideal. And then for the bulls, I think it's reasonable. For the bears, I think it's reasonable for, I think the bears get out above 39 and the bulls buy 2 legs down, possible triangle, always in bulls buy 39. And then where do the bulls get out? They probably get out below 50. And then the bears, they sell below 50 if they're aggressive, but they got to get out somewhere in here. This looks like a leg in a trading range. Definitely get out above 59. Bulls, they can buy 59. And where do the bulls get out? They can get out anywhere in here. It's really tricky to stay long with all this overlap. I think they definitely, if they did hold long, they definitely get out below 72. Bears, they sell 72. And when they sense the momentum slowing down, because you're in an overall, basically, you can call it a tight trading range or a triangle, a lot of those traders short will be quick to get out as 76 starts to reverse up. And then if you're really aggressive, you can buy 76 or buy as 77 starts to go higher. Look at a 1-minute chart and you can see you're getting 3 decent bull bars. The momentum's increasing. Traders will buy or buy the pullback, and that led to a strong rally. That's really tough to do real time. It's easy after the fact, but I think that's the most reasonable stop entries. As far as the best trade of the day, I thought the easiest trade of the day is probably buying above 13, stop below 12, buying above 39, stop below 39. Those are probably the 2 easiest trades. As far as limit orders go, I thought it was a buy below 6, which kind of aggressive, and then buy below the 11 low or the 8 low. I thought it was a buy below 9, but the buy might be in the near 50% and it tests the breakout point 5. So as far as buying below 9, I think you really have to use a wide stop, and it's really better to wait for the selling pressure to go down and start reverse up and then buy. You could sell above 24 or above 23. I thought it was a sell above 27, but if you do, you need a wide stop. And then I thought it was a buy probably below 36 or the 25 low, somewhere in there. And then I thought it was an okay sell above 32, but you have to be prepared. 33 will probably not, if you sell above 32, you're probably not going to go below 32 on 33. And then I thought it was a reasonable buy below 38 for a second leg up, and then probably sellers above, but it didn't trigger. And I thought it was reasonable to buy below 58. And you can buy below bars, you can sell above bars, but really overall tough to do. And if you're aggressive, you can buy above 71, the high one buy for a second leg down. And let's see what else. For stop entries, for buy the close, sell the close, I think it's reasonable buy the close on 15, 16, 17, even 18. But when you start to see a lot of overlap and you look to the left, when you see a lot of overlap and you look to the left and you have a lot of trading range price action through here, you know the odds are you're going to be disappointed and the market's going to go sideways soon. So if you're buying here and your stop's down here, it's probably not going to go straight up. It's probably going to do something like this. And then, so you can buy anywhere in there as long as you're willing to use a wide stop. I thought in here, it's probably better to wait. And I thought it probably became, maybe buy the close 40 if you're aggressive, 41, 42. But when you see the Doji 43, you know the odds are it's probably going to start to go sideways, even if you get a second leg up. So I would not buy 45 or 46 and then sell the close, maybe 55, but I think it's still pretty tough. You're fairly low in the range. You could argue selling 52, 53, 54, but it's really better to sell pullbacks. And then if you're really aggressive, you can buy the close of 77, but I think that's tough for most traders to do. It's really late in the day, and the bar is fairly big. The bar is pretty much 8 points when the range has been fairly small. Take a look at a few questions. Question: when 16 breaks 81, that's a 75% chance. When 16 breaks 81, it's a 75% chance one leg pullback and another leg up. Yeah, I think what you're saying is when you see 16, there's a high probability of a second leg, and that is true. Even when you see this rally up to 19, probably buyers below in a second leg up. Question: if we shouldn't buy third setups in the third leg, does it mean we sit through strong trends that have more than 2 to 3 legs, or is it better just to ignore them, or is it context dependent? Yeah, it's really context dependent. Here, this is a parabolic wedge, 19. And you can see the market rallied and then it paused on 14, rallied, started getting bars with overlap and getting smaller. So that's the end of the breakout. And then it broke out again on 19. That's a parabolic wedge. Parabolic wedges have two-legged pullbacks. However, that is on maybe a 2-minute chart or a 1-minute chart. On a 1-minute chart, you would see the spike in channel. And because of that, the sell-off, let me just show it. This is basically the 10-10 area. So this is it right here. You can see parabolic wedge, rally, pullback, rally, and then a biclimax. The odds are you're going to get a couple of legs sideways to down. We sold off here, pulled back, got a second leg down, pulled back, got a third leg down. But at that point, it's a parabolic wedge to the downside, and then the market reversed up. Here, parabolic wedges are mostly minor, and therefore, most of the time, it's a breakout on a higher time frame, which means it leads to resumption. Parabolic wedge, but a micro channel, probably buyers below in a second leg. In that case, when I see these kind of bars, I often take profits or I go flat, and then I wait to see the 2 or 3 legs sideways to down. In other words, what I don't want to see is a big bear bar and then a lot of follow through to the downside. So an opposite example, when you ignore wedges, something like this. So when you have a wedge, 1, 2, 3, the best you're going to get is sideways trading. Here, when you have a wedge, parabolic biclimax, and a tight bull channel, the best you're going to get is 2 or 3 legs sideways to down, and therefore it's not ideal. So traders do one of two things: they either exit, or they exit and look to buy lower, or they just buy and scale in lower. Here is an example of parabolic wedge in a trading range: 1, 2, maybe 3, and this third leg is subdivided into 3 legs: 1, 2, 3. So if you buy the close of 1410, it doesn't look like it, but 1410 is actually a really, really dangerous bar to buy because it's nested. I did not mean to do that. My computer's going crazy. So if you buy the close of this bar right here at 1410, you're buying a parabolic wedge. Maybe here, 1, 2, 3, or 1, and then the third leg, 1, 2, 3. And I know what you're thinking, but that looks like a terrible wedge. Yeah, but it's a wedge just has a lot of overlap and it's multiple pushes up. And sometimes it's never clear. Is this the wedge right here? It might be. But the point is, the expectation is 2 legs sideways to down at a minimum. And then look what happened on 69. That's a strong enough bar, it's going to get a second leg. And then here, 70, strong enough bar, it's going to get another leg down. And then we got another leg here, and then another bar. So now 3 consecutive bear bars, probably sellers above in a second leg. And in this case, you can see deep pullback in a larger second leg. So when I see wedges in trading ranges, I'm a lot more concerned. I respect them a lot more. Wedges in, kind of like here, selling the close at 25, it's an okay sell to close bar. Odds are sellers above in a second leg. But consecutive sell climaxes and a late bear breakout, low in a range, that increases the risk to get a reversal up. Here, what about this parabolic wedge? Parabolic wedge in a tight bull channel. That's a breakout on a higher time frame, and therefore it'll probably be a minor reversal. And you can actually see you got a couple of bars sideways to down and then broke out to the upside. If you entered on a stop, a question, if you entered on a stop above 13 and trade always in, so if you bought above 13 and trade always in, would you exit a tick below the low of 20 here? Can you talk about 21? Okay, so first off, let's just answer this in two pieces. If you bought above 13, would you get out below 20? I think getting out below 20 is certainly reasonable. You don't know what the pullback's going to look like. Now, the difference is if you get out below 20, you know it's a minor reversal. And this is what basically screws traders up. This is what screws traders up when they trade, especially when they swing trade. The longer you trade, so the more you hear Al say, get out below a bear bar and then buy again above a bull bar. That's traditional always in. However, a lot of traders realistically, they might get out below this bar, but they're thinking about what the leg count is on a smaller time frame. And once they see the market go down, like if you really pull up this chart, you could actually buy the low of 19 and then the market came within a tick of the 19 close and then went down again during this night during 20, and then 21, if I remember correctly, tried to go up a little bit and then went down. So it's basically forming a parabolic wedge. The channel, if you sold below 20, long story short, you'd be disappointed. And because of that, when traders sense the momentum is drying up for the bears selling, what are they going to do? They're going to buy back their shorts. And when the bulls sense that the momentum down is drying up, what are they going to do? Those bulls are obviously going to start buying, and that's what leads to the reversal up. I think you talk about the 21 tick rule below the low rule. Al mentioned it on Tuesday in the room. Well, 21 ticks, I always forget. Math can be hard. There we go. So a 21 tick rule basically means this. So ticks, there's 4 ticks to a point. So 21 ticks divided by 4 is 5.25. So what does that mean? What it means is if you buy above a bar, let's just look here. If you buy above a bar, let me say it differently. So if you buy above this bar right here, it's 17.75. Your entry price is 18 even. And therefore, the market has to go to 23 and a quarter in order for you to make 5 points. So if you buy above this bar, your entry price is 18 even, this bar meaning 13, 19, 20, 21, 22, 23. The market, your limit order for 5 points would be at 23 even. But if the market goes up to 23 even and it touches 23 even, realistically, you're probably not going to get filled. So that's why that's a 21 tick trap, because the market needs to go 22 ticks above your signal bar in order to make 5 points, because you got to have 1 tick above the bar to get to enter, and you need another tick beyond your entry or your target to get filled. That's basically the logic. So a lot of times you'll see them, if you really pay attention to them, you can find plenty of instances where the market will basically fail to go 4 points, fail to go 5 points, fail to go 10 points or 20 points, depending on the range of the bars. Hmm. Anyways, that is pretty much all the time I have for today. As far as tomorrow, remember what I said. We have a climactic bar today, and the weekly chart looks really good. But is the weekly chart going to remain really good but by the close of tomorrow? And that I'm not sure of. We have a decent bull breakout bar, probably going to bounce and get a second leg up, but getting a little bit climactic. But as far as selling, it's really tough to sell, especially when you see a bar like this. At a minimum, I think the bears, if they're going to get a sell off down to down to the low of this bar, they'll probably need a second leg up in the market to go sideways, and then they'll have a chance at a reversal down. All right, appreciate everyone taking the time to listen to this. Hope everyone has a good evening, and I will talk to everybody very soon. There will be no end of day review tomorrow, but I'll be in the trading room so you can listen there if you're subscribed. All right, have a good one.